Trading can be exhilarating. The promise of quick riches lures many in, but the reality is harsh. Roughly 90% of traders lose money. Why such a high failure rate? The answer lies not in complex algorithms but in basic human emotions. We are wired to react impulsively, especially when money is on the line. This instinctual behavior, while useful for survival, spells disaster in the calculated world of finance. Fear and greed, the twin pillars of human motivation, become our worst enemies in the markets. When a trade goes south, fear whispers doubts, urging us to sell at a loss. Conversely, greed pushes us to hold on too long, hoping for an even bigger win, only to see profits evaporate. This cycle, repeated endlessly, is the downfall of countless traders. It's not just about individual trades, it's about the overall mindset. Successful trading requires discipline, patience, and a long-term perspective. Unfortunately, most beginners enter the market with unrealistic expectations, fueled by get-rich-quick schemes and social media hype. They chase the latest hot stock tip, only to get burned when the bubble bursts. This emotional roller coaster ultimately leads to frustration, losses, and for many, a complete exit from the market. Let's dissect the emotional culprits that sabotage even the most promising traders. Fear, a primal instinct, rears its ugly head in the face of potential losses. Imagine buying a stock that starts to dip. Doubt creeps in, whispering, "What if this is it? What if it keeps falling?" This fear often leads to panic selling, locking in a loss that could have been avoided with a bit of patience. On the flip side, greed tempts us to chase unrealistic profits. A stock doubles in value, and suddenly, we're not content with our initial investment. We want more, ignoring all signs of a potential pullback. Greed blinds us to risk, leading to poor decisions and ultimately, disappointment. Then there's FOMO, the fear of missing out. In the age of social media, everyone seems to be getting rich quick, except you. You see your friends bragging about their crypto gains or your neighbor driving a new car, supposedly funded by their stock market wins. This constant barrage of success stories fuels the FOMO fire, pushing you to make impulsive decisions just to be part of the winning crowd. These emotions, while deeply human, are the enemies of sound trading. They cloud our judgment, forcing us to act irrationally and against our best interests. The key to success lies in recognizing these emotional traps and developing strategies to mitigate their impact. The financial markets are a whirlwind of information. Every day we're bombarded with news headlines, expert opinions, social media chatter, and a constant stream of price fluctuations. This overwhelming deluge of data, often contradictory and unreliable, is what we call market noise. For novice traders, it's like trying to have a conversation in a crowded room, nearly impossible to focus on the important signals amidst the cacophony. This noise often leads to analysis paralysis, where traders are so overwhelmed by conflicting information that they fail to make any decisions at all, or worse yet, they fall prey to the recency bias, giving undue weight to the latest news or market move, regardless of its actual significance. Drowning out the noise is essential for successful trading. This involves developing a robust trading strategy based on thorough research and analysis, not on fleeting emotions or the latest social media trend. It also means sticking to your plan even when the market gets turbulent. Remember, every blip on the chart doesn't require a reaction. Sometimes the best trade is no trade at all. This is where the power of technology, specifically artificial intelligence, comes into play. AI trading tools are designed to analyze vast datasets, identify patterns, and execute trades with speed and precision that humans simply can't match. But perhaps their most significant advantage is their immunity to emotional biases. AI algorithms don't experience fear, greed, or FOMO. They don't second-guess themselves or make impulsive decisions based on gut feelings. Instead, they operate solely on data and predefined rules, removing the emotional roller coaster that derails so many human traders. This doesn't mean AI is a magic bullet. Developing effective AI trading strategies still requires human expertise to set parameters, interpret results, and adapt to changing market conditions. However, by delegating the execution of trades to emotionless algorithms, we can significantly reduce the impact of human error and unlock a new level of trading performance.